Hello everyone, I'm Vaishnavi J. Desai, Assistant Editor at Economic Times. Welcome to this webinar by ETCFO and Avalara, Mastering the US Sales Tax Compliance by Understanding Nexus Obligations. We are in the midst of a mature global economy and businesses are increasingly operating across borders, reaching new markets and expanding their customer base. However, entering the US market presents quite a few of unique challenges, particularly in navigating the complex landscape of sales and use tax compliance. Now, there are 13,000 tax jurisdictions in the US, and keeping up with varying rates and regulations can quickly become quite overwhelming. This webinar, in association with Avalara, will help you understand how to safely navigate the complexities of US tax compliance with ease and also gain a deeper understanding of the US sales tax nexus. I'm joined by an esteemed speaker, Krishna T, who's the Director of Sales for Avalara. Welcome, Krishna. Glad to have you on board for this conversation.
Thank you, Vaishnavi. Good afternoon, everyone.
Over the course of the discussion, we will unpack insights, solutions, and strategies which are essential for overcoming the challenges of the US tax compliance and also for seamless registering, collecting, and filing your sales and use tax return. I would request the audience to leave your questions in the chat box, and we will address them to the best of our abilities at the end of the session. I repeat, if you have any questions, kindly leave them in the chat box, and we will address them to the best of our abilities at the end of the session. May I request all of you to pay attention as I have a quick poll question coming up right now. Team, can I have the poll question displayed on screen, please? Yes, so here it is. Are you selling into US or Europe? We are quite interested to know, are you selling into US or Europe? We'll give it 10 seconds, let the audience choose. You can see the poll question displayed. Are you selling into US or Europe? All right. Thank you. I now invite Krishna to begin his session. Krishna, we are eagerly awaiting to understand more about it. So I leave the floor to you.
Thank you, Vaishnavi, and good afternoon, everyone. So we will quickly run through a couple of slides to give you a little brief about the sales and use tax and about Avalara. Start with, Avalara is a global tax technology company, and we are in this business for the past 2 decades. And over the past 2 decades, we have built infrastructure and we have built our expertise in handling global indirect tax automation. So what you're seeing is a little bit of introduction about Avalara. We are, like I mentioned, we are a global leader and we are present across 16 offices with around 4,800 employees. We were earlier public and then turned private and currently a part of one of the esteemed private equity groups on the planet. And just to give you a glimpse, the kind of services Avalara provides, we take care of end-to-end tax, indirect tax automation for our customers. When I say end-to-end, it starts right from registration, tax determination, returns filing, and also remittances in the United States. And on top of it, we also deal with the HS code classification when people do tangible trade or cross-border trade, and also the duty estimates, tax research products, and etc. In last 1 year, in 2023, Avalara did a significant job of determining taxes for close to 48 billion transactions. Yes, you heard it right. It's 48 billion transactions. We filed about 6 million odd returns, and we are serving about 40,000 plus customers across the globe. So how are we able to do this? We are able to do this with the kind of the product suite we have at this point of time. So like we have mentioned about earlier, based on the poll question, and if you are doing business in US, so we'll slowly unpack the complexity in our slides. In my discussion with Vaishnavi, you will be getting to know a lot of significant facts about how US taxation behaves when compared with it of the India and others. So like I've mentioned about, in order to be compliant in the US, it starts all with a kind of a study which you need to do it, which we will touch upon. And post-study, you'll see where you will trigger obligations, you get registrations. Again, you need to determine the tax according to the local rules. And unfortunately or fortunately, US has more than 39,000 jurisdictions, like Vaishnavi mentioned earlier. So every jurisdiction has a very different way of taxability, so which we'll get into it. And post that, filing of the return And the returns frequency are also is different for different companies depending upon your line of businesses and the state and the nature of your transactions, the volume of transactions, and etc. And finally, you will also have to do, if you have physical presence and you have properties and you are dealing with specific lines of businesses, could be like energy, could be like petroleum products, or you have lodging, or someone like a hotel industry, which is having their own properties. So there are various types of tax obligations that would trigger. And Avlara is one-stop solution to all of your global indirect tax needs because we have solutions catering to each of these requirements. And the latest kid on the block, which we are seeing after a successful implementation of e-invoicing in India. Yes, you heard it right. India is one of the countries which successfully launched e-invoicing. We are in the penultimate phase of our e-invoicing as we speak today. While there are many countries which are starting off, and the recent one, which is going to start from 1st of August, is going to be Malaysia, which just announced a couple of days back, right? So we also have our e-invoicing and live reporting solution that support around 60 odd countries as well. So why there is a need for a solution like Avlara? Because if you look into it, there is a constant flux which is emerging in both from the government's end and both also from the business perspective as well. So there are definitions which are getting changed, which we'll also touch upon in due course of our presentation shortly. And wherein we also talk about the remote seller definitions are significantly different when it comes to different countries. And the marketplace facilitator laws, which also subjected to a lot of changes. And there is a huge demand from the tax authorities to determine taxes on the real time and also stay compliant. Needless to say, with all of the finance and the tax leaders who are there attending this event at the moment, you are pretty much aware out of your experience, the cost of non-compliance is significantly higher than the cost of compliance. And we will also touch upon a couple of scenarios when time permits, where we also talk about what is the impact of non-compliance and how could someone avoid that kind of a non-compliance with a structured compliance procedures. Post-COVID, there is a significant thrust in usage of technology, both from the government's end, and a classic example is the European countries. When people who are selling into the Europe might really understand this, there are significant amount of European countries who are asking for a paper filing as a part of your VAT returns pre-COVID, and post-COVID everything started getting digitized. And there is a lot of emphasis on virtual audits, e-reporting, e-invoicing, and electronic file sharing, and etc. And the latest thing with the impact of the AI, where people think like AI is good and bad. So I'm not really trying to get into that debate at this point of time. But for a moment, let us assume that AI is good because it also reduces some of our manual errors. And few states in the US have already deployed AI bots to skim through and read through various loads of data to figure out the businesses which are non-compliant with US. And especially from a sales and use tax perspective, they are piloting this project by deploying AI bots. And one of these states, which is very eager in this part, is going to be California, where they are bringing in AI bots into the place and to figure out if there is any kind of a non-compliance by any particular business, and they're going to identify it. So with all of this, while we are talking about the errors, but there is also a cost component when we are trying to keep up the manual compliance. The first and the most important thing is people. While I'm a strongly opinionated person when it comes to AI doesn't replace people, but it replaces people who don't know how to use AI for their best. So AI is a critical success factor and it needs to be an aid in the process of your businesses. While the direct cost, which every company or every organization look at is people and the time invested in the process and the kind of a cost more from an infrastructure perspective and the direct and indirect taxes. So it is imperative a technology solution can be a best answer to address both your cost related aspects and also your compliance related aspects and bring in more efficiency both at the team level. So does that mean like we should get rid of the people? The answer is no. So we can utilize the people in more revenue generatable activities. So that's more the important point which we need to look into. So with that note, I just want to leave the audience with a quote, a famous quote in one of the business journals, which says, like, the technology solutions are capable of managing the entire processes, including data collection, analysis, compliance, and audit activities. So, needless to say, technology is the key to the future of the tax. That note, I'm turning it over to Vaishnavi.
Thank you, Krishna. Technology really is the key, and we are so excited to know more about the possibilities that will open up. Before we go into the fireside round, I have another poll question coming up for the audience. Team, can we have the poll question displayed on the screen, please? Here's the next poll question. What do you think is the estimated number of sales tax rules and changes in the US in the past 1 year? Krishna has already quizzed me on this, and I will keep the answer secret, but we are keen to hear what the audience thinks. What is the estimated number of sales tax rules and changes in the US in the past 1 year? We'll keep this on for under 5 seconds. All right, let's see. Krishna, the presentation has thrown open so many possibilities and interest, especially around the US sales and use tax, and the need to understand the terminologies, especially. There were quite a few that you mentioned, and I'm sure you'll be able to give more insights on this. I would also like to know insights on the impact of these terminologies. What do these mean? What do these mean for Indian sellers? So join me for a quick round of Q&A, Krishna.
Sure, Vaishnavi. Go ahead.
Perfect. So let's begin with an understanding of the system that we already have and how it compares to the US system. That is how the audience will be able to make a connection. So what are the key differences you say between India's GST and US's sales and use tax system?
So India GST is one of the most recent tax changes which happened for us in 2017. And so more or less, like both the sales and use tax, there is a significant change which came up in sales and use tax in 2018, which we'll touch upon shortly about it. And the striking difference between these two is whether it is VAT or GST or even SUT on one side. So when we look at the supply chain, Vaishnavi, in VAT and GST, every leg of your supply chain is taxable. So let's take an example. A distributor is selling it across to a retailer, and the retailer is selling it is to the end customer. So what we do as a practice is when the distributor raises a kind of an invoice, he would add additional amount of GST. Let's say, for example, for the ease of calculation, let's talk about 10%. The rate doesn't exist, but let's say for the ease of calculation is 10%. So 100 rupees and 10%, which is 110 rupees, is the invoice amount which the retailer will pay to the distributor. And the retailer will add his or her margin, and then they sell it to the customer again at 10%. So if you look into it, there is a tax levied in phase one and phase two as well. And when filing of the returns, the retailer will use the amount he already paid to the distributor as a credit. So technically, on all of your purchases, the tax paid, you will have a credit. We call it as an input tax credit in GST. And in VAT regime, they call it as VAT credit. And that's the first cultural shock which Indian businesses or any businesses operating in VAT and GST will face when they get into the US. Because in US, there is no concept of credit at all. If I replicate the same transaction in SUT, the leg of transaction between the distributor and the retailer is non-taxable, provided the retailer provides a certificate saying, hey, I'm going to resell these products. So hence, please do not levy any kind of tax. Depending on collection of the certificate, the distributor will not levy any kind of a tax. And the retailer, when they are selling to the end customer, they will apply the local sales tax rules and also the local tax rules, and then collect the tax and remit the tax to the governments. So this is a big significant difference. Since there is no tax levied in the first phase, so there is no concept of credit. So now the retailer cannot go back like I've already paid it, so I'm going to set it off. There is no concept of that of credit at all. That's the first one. And the second is about the kind of a reporting of taxes. So we have a standard date and schedule for reporting of a GST. So GSTR1, we do it by 11th, GSTR3B, we do it by around 21st. And that applies for every business who are under the ambit of GST. But when it comes to the US, it is more dependent on the state's discretion and the businesses. If there are two businesses operating in the same state, one business can be asked to do a monthly return, and the other business can be asked to do a quarterly return. And the quarter might also start as Feb, March, and April instead of the Jan, Feb, March, which we usually have. And as you all know, the US obviously follows the kind of a calendar year kind of a pattern. They don't really follow the financial year pattern like we do in India. And the third and the most important thing, there is a governing body like GSTN for us whenever we want to go back and any kind of a rules, changes, and etc. But when it comes to the US, it is more driven by the states and the jurisdictions. There is no central body. So a classic example, a software in India is taxed at a flat rate of 18%. And if we can really show like I'm using the kind of the software for an R&D kind of a purpose, so then there is a kind of a little bit of a leeway by about 1.5% for the companies which are using it. But the same software, when it is sold in the US, it is taxed in 468 ways. So it also depends. The software is non-taxable in California. The same software you sell in Texas is at 80% taxable and 20% non-taxable. And in certain areas, it is completely, the license of the software is non-taxable, but the implementation is taxable. So it is different depending upon the different jurisdictions and the state.
So let's come to the states and jurisdictions themselves, because there are so many of them. How do tax obligations differ across states, jurisdictions? One. And then what unique challenges should businesses be aware of when expanding into the US or in the states in the US? How can businesses then manage the complexity that arises with the sheer number of jurisdictions and the respective rules in those jurisdictions?
All right. So to answer this question, probably I'll go back to the poll question, which we looked upon. And the number of changes, I'm sure many of the Augustus audience here would understand the number of changes. In India, we don't really call them as changes because ours is a fairly structured tax regime with few slabs all in it. And we call it as circulars. And the kind of circulars we received in 2022, I'm not really sure about the 23 number. In 2022, the India GSTN faced about 4,500 odd circular changes. However, the same thing, when we really replicate in the US, in 2023 alone, they were close to around 200,000 plus tax changes and rules. Yes, that's a mind-boggling number. I think that clearly answers one part of your question, when there are these number of rules and etc. So it is imperative that you cannot really manually keep a track of your taxation. So how does businesses deal with this? So every state has got their own kind of a nexus rules. And if there is a kind of an economic activity, if the businesses breach an economic nexus or a physical nexus in any part of the state or in any of the states where they are operating in, it is important that they need to get themselves registered for sales tax in that particular state, start levying the tax, collecting the tax, and remitting the tax. And how do they really know if they have breached the nexus in any particular state? Yes, the first and only thing is they should keep monitoring their transactions. And every state has got a different set of rules and thresholds. And the usual threshold is about $100,000, but states like New York has a $500,000 as a threshold, 100 transactions. So there are combinations. Some states take the route of combinations with number of the volume of transactions and the value of transactions. Some states are very clear. They are not bothered about the volume of transactions, but they are more worried about the value of the transactions. And these rules keep on changing. It is not static because the states and nexuses are also emerging as businesses are progressing as well. So with the kind of the complexity which is constantly having it. So it is imperative that the businesses should really keep a technology solution in place to keep monitoring their activities and be vigilant where they are really hitting the nexus, breaching the nexus. And in certain states, there is only a rule where they would only consider the total sales. Some states do consider only the gross receipts. So it has to be a constant job when they are trying to do business in the US to keep a tab on how they are breaching the nexuses in each of these states.
All right. So you mentioned the word nexus. So can you explain in detail what a nexus is and how businesses can determine if they have triggered a nexus in a particular state?
All right. So nexus is the dearest word for anyone who is operating in the US. I'm sure, like with this statement, many of the audience would definitely bring smile on their face, because that's what they hear whenever they try and do transact into the US. So Nexus, by definition, is nothing but a prerequisite condition. It could usually be an activity or a transaction, and it is between the state and the taxpayer, and through which the state can impose the taxpayer with the kind of the jurisdiction rules and etc. This is the actual definition when we really talk about as per the law. So, but technically speaking, it is just a kind of a monitoring of your activity and your transaction. And there are multiple types of nexuses which we are talking about. So people might be wondering, like, if I am doing business in the US, so what are the various kinds of rules where I can really where I can trigger Nexus? Or what are the other scenarios where I need not really trigger Nexus as well? We'll also touch upon that. So the first thing is, depending upon the economic activity, which is the most common sought after Nexus type, depending upon the activity you do in that particular state, whether it is $100,000 or $200,000 or the number of transactions, it is depending upon the state they are operating. And another crucial factor which needs to be observed is the product taxability or the service taxability which you are doing. Often many kind of services are non-taxable. When you take about like the tax and audit services, they are non-taxable in majority of the states. So the word which needs to be observed here is in majority of the states. It doesn't mean like in every state it's a blanket approval that all recruitment services or all people management services are non-taxable. No, that's not correct. It is important to understand the nature of the service you are rendering into the particular state, the value of the service you are rendering into the particular state, and in the process of doing business, are you also getting into some kind of in-person activities in that state? And it could be more like attending an event or a trade show, or you set up a small temporary shop for a 5-6 days, and you start selling your home decor items or tangible items, and then you're just selling it off. And jewelry companies, it is a rigorous practice from the Indian jewelry companies and brands, where they go with the entire material, set up a small shop in a place where there is a lot of Indian community. They sell it and they come back. These all are activities which comes under the ambit of Nexus, and which can trigger the obligations for these companies.
Understood. I'm sure that's something to remember, but that gives rise to another question. So is Nexus a fixed constant or a continuous change that needs to be monitored? And in what situations and what type of nexuses can be triggered under the US sales and use tax?
Like I mentioned, Nexus is constantly emerging and evolving concept. And a classic example to that is the state of Maine. State of Maine in around 2018, 2019, around mid of 2018 and 2019. So they started off with both the kind of a scenario, both volume and value kind of a thresholds. The value threshold is about $100,000, and the volume threshold was about 200 transactions. But out of the blue, and by mid of 2021, the state of Maine have decided that they don't want to pursue the volume transactions, and they've just get rid of the volume threshold kind of a concept at all. So now from 1st of Jan 2022, the state of Maine considers $100,000 as the threshold if you're breaching Nexus. So this is continuously happening because states already realized that the volume of the transactions is not a great parameter to be looked upon, just because there could be small players, there could be people who are selling about $100, $200 worth of shipments and etc. So they just want to be vigilant about it and promote trade as well. But on the other side, there could be companies which are doing significant value of business with one invoice about like $50,000 or $100,000. So that is also potentially breaching the Nexus. So states are considering their changes, and we can expect a lot of changes, more not just from the threshold perspective, but also from a taxability perspective.
Mm-hmm.
And classic example for that one is the state of Utah. The state of Utah, they also consider both your exempt and non-exempt sales as a part of your sales for you to breach the nexus. Their limit is about $100,000. Even if your service is non-exempt, is an exempted kind of a sale. In fact, you do a kind of any implementation services. Usually are they are exempted in the state of Utah, but still, you still breach the nexus in the state of Utah and you are supposed to register and file nil returns. But the state can also have a different standpoint on this. The classic example is again from California. In California, as you know, which is the holy grail of the entire software world.
Absolutely.
So whatever the kind of company we look in, they're in California. So technically, all the employees are present in California. So they are breaching physical nexus. So they have to get themselves registered and also levy the tax and collect the tax and remit the tax. But software is a non-taxable item in California. So even I have a registration, I might raise an invoice for about $100,000, but the tax component or the tax rate is zero. So the tax component is zero. So now the California government, in fact, they have to take a lot of time, energy, and dollar to process a nil return through which there is no return for the governments as well. So when one of the CPA firms, where we are, who is a partner for Avalara as well, when they were dealing with this, the California government clearly mentioned then to them that we are not going to process your registration request because you're anyways going to do a nil return. And in fact, it is a drain of money and time and energy for Californian government to process nil return, right? So these rules keep on changing. It is not constant. And how can we really start looking at and keep a track of all of these? It's again, like I go back to my same point earlier, which is humanly impossible to do it. And to the second part of the question, which you were mentioning about, what are the other ways we are triggering it, correct? So
what types of nexus?
Yeah, please go ahead.
What types of nexus?
Yes. So the different types of nexuses. So the like I've told you, the major one is economic nexus, and the second one is physical nexus. You are having a physical outlet, or if you have a presence in a state, you have employees working in that state, or you have your own office in that state, or you attend an event in that state. So that can also trigger a kind of a physical nexus. And some states also have trailing nexus. So a company did business in a state and they've shut down for whatever might be the reason. And they just pulled the plug from that state. But the state still wants them to file returns for a period. It could be 6 months, 8 months, or 1 year. So that just to confirm that they are not really doing any more additional business in that state. This is called as trailing nexus. There is affiliate nexus with the rise of the e-commerce world and the e-commerce transactions happening. So there are a lot of affiliates and the affiliate marketers spread across each of the state across the United States. And then they trigger affiliate nexus. There is another concept called as click-through nexus as well. So nexus is of multiple types and it can come in any direction.
So you explained the whole landscape in a bit, but how can businesses ensure that they remain compliant with these regulations?
Right. So I was attending an event few months back, and I heard a very good word, which is called as compliance cholesterol. I'll also tell you why I really picked up this word. So when a business is doing a lot of activity in the United States, it is important they monitor their activity and see the states where are doing businesses in. And it is equally important for them to figure out if they are transacting into a particular state and also understand what is the product taxability in that particular state and what is the kind of a threshold which is there. And another misconception which businesses usually fall into a trap is they would usually try and give the tax determination on the billing address. So let us suppose there is a company headquartered in California, but they also have a branch in Texas. And the company asked the vendor to bill it on their California address. But as such, the licenses are used in Texas, for example. So in California, it is a non-taxable item, but in Texas, it is a taxable item. So understand the nature of the transaction, because it is important to determine the tax on your shipping address and not on your billing address. It is a common place of supply rules, which is there even for Indian businesses or even European businesses or anywhere. So the place of supply is going to be a crucial aspect. And determine the accurate tax, because the governments are vigilant about it and they have every piece of record to figure out when the tax rate changed, what is the kind of a tax window they were given for to accommodate this change, etc. And usually retailers do fall into this significantly, because there are tax holidays which are announced for a particular day or two. So if someone is visiting, let us suppose, into New Jersey in 1st of August to 3rd of August, so you can go and buy books, because there is something called as back to school period. And when you buy books, there is a absolutely zero tax both on sales and local tax as well when it comes to the US. So it's important to understand the tax and changes which are happening on that very particular day. And finally, if you have collected the tax, ensure that you remit the tax and file your returns. So there are businesses which I have encountered in my experience where they have collected the tax and they've hold it on against and their balance sheet as a liability. And at that point of time, there is not much to really do, because then you will be definitely be under the ambit for non-compliance, and you can be pursued with a notice.
Perfect. Now, there is one point that I want you to address. That is a remote seller point. So who qualifies as a remote seller, one, under the US sales and use tax laws? Which businesses are covered? And especially when it comes to Indian businesses, what should Indian businesses do to be prepared in terms of compliance and regulations?
That's a great question. And again, it's a burning question in many of our discussions with prospects. So people usually think remote seller as a definition is confined only to the United States. So it is not mandatory that the selling entity has to be in US and the buying entity is in US. So remote seller by definition is every time looked upon from the lens of the state.
Okay.
Right? Imagine the transaction is happening between Texas to New York. Or let us take Delaware to New York, because in a majority of our Indian companies are Delaware cops, not just in India, any of these one, because Delaware doesn't have sales and use tax. So when there is a seller sitting out of Delaware and the buyer is in New York, from the lens of the New York tax authority and the seller, the Delaware buyer, the Delaware seller is every time considered as a remote seller. And same is the case when someone sitting in New Delhi in India and selling it across the New York, he is also considered as a remote seller. So that's a myth when people think remote seller is only limited to the US. No, anyone selling into the US, any non-US seller selling into the US is considered as a remote seller. Along with any seller selling from a non-state, in the sense like, when they are selling from a different state into the different state, they are also considered as a remote seller. So please be vigilant on it. All Indian businesses selling into the US from Indian addresses are definitely remote sellers.
Now, how should they be prepared in terms of compliance with the regulations?
So remote sellers, like I mentioned about it, is they need to be looking at what are they trying to build, and what are the kind of product they are really selling into the particular state, in which state, and monitor their nexus significantly. And the second and the most important aspect is usually sellers do get into some kind of a trade show, or they also get in to understand what is the feel of the market. And a state like Arizona, when you try and spend about 3 working days in a calendar year, they would say like you are triggering physical nexus because you are present there to study the market. So it's important to understand if you are trying to do any kind of a business activity that can potentially breach nexus in that state. And then you are supposed to get yourself registered, levy, collect, and remit the tax. And if you are not breaching nexus, there is no obligation for any business to register for sales tax registration. Since you are not registering, you need not collect the taxes at all. So just be vigilant about it, see what and monitor it. And the monitoring of Nexus is never ever an Excel tracking. So please be also aware of that, because the rules constantly change, like I've mentioned earlier.
We will come to that, Krishna. There is an important question that I'll ask. But before that, What are the key steps involved, you'd say, in filing sales and use tax, and how can businesses streamline this process? I'm sure it's as complex as we think it is. So, how can businesses then streamline it and make it easier for themselves?
Right. So I'll before going into the question, I'll also add another point here, Vaishnavi. You really brought a significant thing, because India as such is every time is looked upon more as a kind of the offshore business, where we really bring in a lot of services and other kind of an expertise to our US clients, right?
Hmm.
So what people think is, when I'm since I'm into services, am I completely exempt? Since or they might be under the assumption that we are totally exempt.
Hmm.
So the important point which looked upon is there are three scenarios where you can be completely exempt from sales tax in that particular state. So one, if you are selling a product which is exempt, and two, if you are selling a service which is exempt, and three, this is called as a de minimis law. So usually this is more for tangible items, and especially in the apparel and the footwear side kind of segments. Majority of the states fall into the apparel and footwear segments in this case. The de minimis law clearly states majority of the states usually follow a rule like if your product is less than $100,
Hmm.
then there is no tax levied on that particular transaction.
Hmm. Hmm.
So please understand, if your business or your offering falls into any of these three categories, then you are usually exempt. And also be vigilant, look at the legitimate resources about the tax rules, changes, and etc., which can give you a right report at right point of time to figure out if you are levying the right tax, or are you also calculating the right nexus or not. So that's the one additional point which I wanted to add to you. And coming to the point of the returns,
Hmm.
the first step before we even talk to returns is to get registered.
Hmm.
So if you're breaching Nexus, we talked about it all through, they are going to register. Second, and the most important thing is, please determine accurate tax. People usually think in US, if we can give a zip code, that's more than enough as a parameter to determine the taxation, which is absolutely wrong.
Hmm.
So a mere zip code can never give you an accurate tax. I'll give a classic example. Imagine there are 4 blocks in an area. Block 1, block 2, block 3, and block 4. Someone purchased an item in block 1 and someone purchased the same item in block 4. Usually it is the same zip code. But in US, there was a classic case where the one in block 1 was levied a tax of $2.50, and the one in block 4 was levied around $3. It's the same zip code. But if you really do a rooftop mapping, the block 4 is in a certain part of the city, or a part of the under the specific jurisdiction of the city, where there is an additional $0.50 which is levied as a part of the tax. And this is usually happening whenever people do only based on zip code. What happens with zip code? You just go with the accurate data. In the sense, like the highest tax rate is what something, you just pick it up. So Texas has 8.25%, and it can as good as low from 6 to 8.25%. There are stances when one company just went straight away and they started billing at 8.25%. But as such, when they really did the kind of a location mapping and etc., so then they were supposed to determine only tax at like around like 6.5-7%. So this kind of a discrepancy happens when you don't really have systems, or when you follow a procedure of not determining accurate tax. So what is needed to determine the accurate tax? The address has to be clear. You should have your kind of line address 1. Of course, the line address 2 is the city and state, and then you can have an accurate tax determination. And once you determine the accurate tax, then comes the point of your filing of your returns. And usually, like I've told you, the states determine or give you a frequency and your date of filing depending upon your businesses. So monitor it and try and file your returns way ahead of the schedule. And majority of the states also offer certain kind of incentives and also some kind of waivers for companies who file the returns well in advance. States offer like a 50% waiver, a $50 waiver on your total tax liability if you file before 10th. Imagine your date of filing is about 21st, before 10th of the month when you file it. So you get a $25 or a $50 waiver on your tax amount. So be vigilant and file it. And also please maintain the record of that one, because the state authorities can come back to you at any point of time and asking for any kind of support document or material post you file your returns.
So what's the limitation on maintaining the records?
So usually the period is about 8 years, is what the look back period for the governments is about 8 years. And but when you file the returns, the kind of when they are processing the returns, they might come back to you whether no you determined the wrong tax rate, or probably can you explain you call this as an exempt transaction. You didn't levy the taxation on this transaction. Do you have an exemption certificate on record to be proved? Because often states do ask you to attach the exemption certificates or quote the exemption certificates when you do the exempt transactions. And what are the kind of an exempt entities? That's an important point to touch upon, because that's going to have an impact on your tax determination and also on your return filing as well. If you are selling to your resellers or your partners, and if the reseller or the partner gives you an exempt certificate, it is an exempt transaction. There is no tax on that one. It is zero tax. And when you deal with federal governments or state governments or charitable organizations, so every charitable organization or the federal state government have an exemption certificate, which is clearly there. Ensure that you are collecting that exemption certificate, then only please levy your tax component as zero. Else it is as good as a taxable transaction. So being vigilant on these steps and filing on time are the potential checklists which the businesses have to keep a tab on when they're doing business in the US.
Perfect. So we understood the landscape. Now, we also understood the challenges that come with the sheer number of it. How and why is tech and automation the best solution to manage the sales tax compliance, and not just managing it more efficiently?
Okay. That's a great question, Vaishnavi. We talked about the number of tax changes a while ago. We're talking about close to 200,000 odd tax changes in one calendar year. Right? So it's almost 1,000 odd tax changes on a working day. And if you have to keep a track of everything and every change, so you need to deploy an army of team. So like I mentioned in my slide, the first parameter is going to be people there. And you need to have the right person with the right expertise at the right moment, and they have to be vigilant about it. Yeah. And second and most important thing is, you are breaching Nexus, and Excel is definitely not the right way to really look into it. You need to keep a tab on your transactions, and you are using sophisticated systems like Oracle or an SAP, or any of the commerce systems could be like a Shopify, Magento, and etc. Correct. You cannot every time pull out or download the report and again run it through your Excel, be it macros or anything, and then figure out like, hey, what's that going on? So you definitely need a technology solution, one, to keep up yourself to the tax rate and the changes, and understand the nuances where you are hitting Nexus, and figure out what should be the course of an activity. If you want to register and figure out, am I breaching Nexus, or should I really register in this state or not? And the most important aspect for any CFO or a tax head is they are not back office experts. They are a key member in the chief strategy panel, which is organized. Now, if you really look at it, there is a new position which is being created called as chief value officer, chief strategy officer. And all of the chief strategy officers will set up a panel whenever they want to grow and expand into other geographies. And one mandatory person or one mandatory resource which needs to be a part of this panel is the CFO or the CTO for sure. Because when businesses are expanding into another country, it is not just about your product and your penetration and your go-to-market strategy. The critical success factor is what are the tax implications your company can encounter when you get into a particular region. You need to know the law of the land before you really start thinking about expanding your business into it. So the tax officers or even the CFOs, they are not supposed to look back at the books. Gone are the days probably when I started my career. I could really see like it's very tough to get a time of a CFO, because he or she was under tremendous audit procedures with excise audit, manufacturing audit, trading audit, service tax audit, VAT audit, CST audit. So there were so many audits going through them across the year. Now the tax authorities or the CFO team should be really looking at what is the EBITDA and how are the sales picking up. And we at Avalara, we practice this, and we are a strong advocate of this one. we clearly say finance leaders are the ones who deserve the seat and in future strategy table. So if we
Right.
want to get this done, so we should really remove the clutter. And this is a mundane, trivial task of
Mhm.
compliance which needs to be taken. When that can be handled by technology, you still have much lot of things to do. So that's a very important step, both from a managerial perspective and also from a CFO office perspective to implement technology in it.
Perfect. So you did explain the solution. First, you explain the challenges, you explain solution. What will help the audience understand better is if you can provide some examples of how Avalara has helped businesses resolve some specific sales tax compliance issues.
Great. So I'll take a couple of examples. So one classic example is of a unicorn based out of India.
Okay.
And they were doing a significant business for about $40 million or so every year in the US. They were already registered around 8 odd states. And we had discussions, and they already adopted Avlara. During the course of the discussion, we strongly recommended them to do the sales tax risk assessment study to understand if they have really breached obligation in other states. And the response from the finance leader was, we are tracking it on in an Excel. We are fairly good, so we are happy with it. So we went ahead, we deployed Avlara. There was a they were using one of the sophisticated systems, one of the named ERPs. We have a connector readily available, and then everything is done. But out of the blue, the company received a notice from one of the state's tax authorities for about $400,000. It is one state. And then we started doing it. And once you get a notice, there is no looking back when it comes to the US. And now with a lot of streamlining happening in India as well, where you have faceless inquiries happening, and you have also the kind of representations, and you never know who is the assessment officer joining, whether they're going to join from Guwahati or the next one is from Hyderabad or someone is from Bangalore. So with the kind of the faceless assessments also picking up in a country like India. So US as such will be more looking at, once you receive a notice, is you only have a way is go ahead and pay the penalty. And then after a lot of persuasion, the finance leader gave in and he said, let's do a study. And when we did this study, it's a comprehensive 90-page report, which will talk to you about your transaction for the past 5 years, where a team of tax professionals at Avalara analyze every of your transaction and say, hey, you breached Nexus. Here is your liability per state. And this is the course of action you got to take, whether it is a sales tax registration or you need to do a voluntary disclosure agreement. So both of these, voluntary disclosure agreement is every time a pre-notice stage. Once you get a notice, the only thing is either you try and go ahead and defend the notice, and which usually happens, and then the state might take a stand of waiving of your penalty by 6%, or probably waiving it by 100%, depending upon the merit of your case. But they don't really waive off the interest on penalty. And once you make the penalty, and then you get cleared. And the results were shocking after looking at the entire the risk assessment report. They have breached Nexus in 13 other states. So imagine, does Excel tracking help? No. And I would still say it is very fortunate that the other 13 states didn't really shoot a notice. Imagine if there is a average $10,000 worth of notice from 13 other states, then out of 14 states, there is a total liability of about $500,000. And the person who faces the wrath of this is going to be the finance leader or the CFO. Because he or she is going to stand in front of the firing squad, both from an investor community and also from the board, from the management, about why didn't we really keep a tab on this? So this is the point where I talked about your compliance cholesterol. So these days, we are more concerned about a health, which is very important. Absolutely important. I would still say health comes first than anything else. So while we are doing our diagnosis about what is our lipid profile, what is our HbA1c, what is our glycemic index levels, and etc., it's also important that businesses also have their certain tests to complete. So one of that, when you are doing business, is do this risk assessment. So you will get to know, do you have enough, is your compliance cholesterol well within limit, or is it above limit? So then accordingly, we will take the next course of action. So that's a classic case which we have seen. And this is one of the cases, out of the a lot of customers who are there in India operating with Avlara. So we have seen these cases every time because people every time believe that I am selling from India and I don't have any knowledge about the law in the US. So you cannot go in front of the state authorities and say, hey, I'm non-cognizant about your law. And that's kind of a weakest argument any businesses can really give. So it is important. Please maintain your, be vigilant about it, your activity in the US. Do this kind of a check. And you can do it, once for the past 12 months, or probably you can also do it, once in every 2 years. So which is important for you to figure out where you are breaching, what is the next course of action you want to take.
First comes health, then comes US sales and US
Yes.
tax compliance. Okay. Okay, last question. So now that you spoke about the solution, what features should businesses look for when they choose a sales tax compliance solution?
So first of all, try and look at I'm trying to respond to this question more as a tax technologist and not as an Ablarian.
Mm-hmm.
So as a tax technologist, my recommendations would be around the first thing which the company should really look at is does your solution have enough coverage to accommodate? Often you'll find solutions in the market where they would say, hey, we support only US, or we support only India, or we support only, we only support tax determination. We don't really support the filing. So look at the entire solution coverage. So you should have, as you are starting with US, and you might also get into Europe, or you might also get into Nordics area, you might also get into the Asia Pacific. So you cannot be having 10 other systems to work with you. So then you are completely lost, because end of the day, you are going to consolidate all of this into one single report. You need a solution that is scalable across the platforms and across the regions. And second, it should have a good amount of partner and connector network. So when you use multiple systems like Oracle, there are many organizations, at least in India, where they have two ERPs. They use an SAP and they use Oracle. They use NetSuite and they use Oracle. So it is important that you have a system which has connector networks and which can really give you pre-built connectors so that you can easily assimilate the data and have a unique view of your data. And find a solution which can give you accuracy guarantee in a complex world like US. So often people can give away because you are the one who is facing the tax authority for any deviation in the tax determination. You should have a service provider who can really help you with the data, with the argument, with logic, with statutes to say, yes, this is the reason why the tax rate is determined. Find a solution which can give you an accuracy guarantee. And third, what is the point of automation if cannot really do an end-to-end tasking, right from your tax determination till the remittance of your tax? So find a solution that can cover the entire spectrum for you. So you are hassle-free. All you need to do is probably log in, just look into it, see if you have really breached the Nexus. With a click of a button, you have someone reaching out to you to determine and do the next kind of registration requirements, followed by your remittances, and automatically do the remittances to the government so that you are hassle-free. So look at a partner which can give you a good night's sleep instead of you trying to wake up with the kind of a compromise.
Correct. So someone who provides the end-to-end solution for you and makes your life and job much more seamless. Basically, someone who can give you efficiency, save time.
Yes.
Perfect. Thank you so much, Krishna. Our audience also may have a few clarifications and questions of their own. So let's move to the audience questions, shall we?
Yeah.
So if a US company hires the employees or contractors from India for US project and bill it in the US, is any tax involved in India for the US firm?
Can you repeat the question again, please?
A US company hires the employees or contractors from India for the US project and bills it in the US. Is any tax involved in India for the US firm?
See, I think from an India perspective to the US arm of the same company, right? In that cases, there is a kind of a direct tax involvement, which is more from a transfer pricing perspective, which I'm not an expert on. So when it comes to the US part of it, I'll answer that part of it. Since the invoice is being raised from your US entity to the end customer. So if your US entity is operating in a particular state and your customer is in a different state, so look into the kind of the taxability of your service or your product in that particular state which you are rendering. and also see if you're breaching the nexus. And accordingly, you'll become taxable. If you're under the taxable ambit, levy the tax rate, calculate the right taxes, and remit the taxes to the government.
So, Mr. Jacob, definitely there is a nexus triggered in the US because you're hiring the contractor. Doesn't matter if you're hiring the contractors from India, but it's for a US project and you're billing it in the US. But for India, you'll have to check with someone else.
Yes.
Definitely keep in mind all the points that Krishna raised. So you're definitely going to trigger a nexus in the US for sure.
Yeah, because the invoicing entity in the transaction it is invoiced from US to US company. So definitely
Yes.
you are clearly diverging the fact that I am present in US. So in that particular state where you are in, so you have to definitely you already have a sales tax registration in place and see the value which you are transacting. Is it in the same state, which is an intrastate or an interstate transaction, and look accordingly. And they want to really understand the direct tax implications of that one, so they can reach out to me or my team, and we can put across to the kind of partners who can help them with the US direct taxation as well.
All right. So if I don't have a physical presence in the US and sales are made via e-commerce site, will I trigger a nexus in such a scenario?
So this is a classic example for remote seller.
Understood.
So you got to monitor it and what kind of transactions. And if you are an e-commerce company, there is also another important aspect to be looked upon. What is the value of the goods you are shipping in? If the value of the goods you are shipping is above $800, which is the de minimis as per US law, then you are also supposed to determine the duties as well. So we usually have the duties. You buy a product, they say, hey, there is an import duty of around 8% or 10% and etc. Right? You will also be qualifying for yourself for the duty as well. So be vigilant. If you are an e-commerce company, look at what is your AOV. If you are above $800, definitely you have customs duty to be paid, and then you also need to have the local taxes to be paid.
So $800 is the magic number that you need to keep in mind.
Yes, that's your average order value.
Correct.
And be vigilant about your nexus as a remote seller.
So if business employees made sales to the US customers at a trade show, and we'll come to another question on the trade show, are they required to collect and remit sales tax on these transactions?
The answer is yes.
Okay.
The answer is yes, because there is an obligation, especially from a trade show perspective. That's a very trickiest part. There is something called as temporary nexus that this might trigger when they are trying to do sales in a trade show. And it is different for different states. They need to understand what are they trying to do it, because it is clear that they don't have a physical presence in the US, but they are exhibiting the products in a trade show, and they are also doing the selling in the same trade show. So then it is important that since they are doing a selling activity in the particular state, and there is a checklist for these kind of people who are doing it. So it should start from, please be vigilant about, do that checklist. You are in which trade show you are participating, what is the law of the land, and what is the kind of tax rate, because you are going to give a sale receipt to your recipient in the same trade show. And so at that point of time, since the purchase happens, you are going to give a receipt to them as well. And you should also get yourself registered for that, for the sales tax as a pre-event activity, and then also collect the tax, and remitting that is a crucial aspect of it. Please, whatever the tax you collect, do remit it to the governments. Else, that's the easiest route for the governments to track you back and put you into a non-compliance bucket.
Krishna, a lot of trade shows happen either in Vegas or in Florida and parts of Florida. Now, a lot of companies that our audience today also are partners for these major tech giants or affiliated to them. When they go to states like Nevada or Florida, what really happens then? So is there a nexus that gets triggered, or what are the exemptions? If you could immediately brief us a little bit on that.
Actually, I'm glad that you picked these two states like Nevada and Florida. So when it comes to Florida, like I've told you, we talked about California and the kind of nexus rules. Right? In Florida, there is no physical nexus triggered by attending an event. That's why you'll see a lot of fashion, retail, apparel trade shows happening in Florida, Miami, etc. It's the event capital, technically. But on the other side, when you really look at the state like Nevada, And the important aspect we understood here is, are they participating in the trade show or are they participating and selling in the trade show? So if they are
they just meeting potential customers, or actually they're selling it to them?
Yes. If they are selling in a trade show in a state like Nevada, they can sell in a trade show in the state of Nevada for only for two kind of trade shows in a period of 12 months. So imagine you already exhausted your two trade shows and you are in the third trade show and you're doing it, then you are triggering Nexus and you have to register in the state of Nevada. Another important thing is about a state like Georgia. Georgia is also a home for a lot of companies. Many companies have their kind of place in Georgia. And in Georgia, when you are at an event and you are selling, the threshold is about $100,000. Till you reach $100,000, you need not really levy any kind of a tax. The moment you cross it, you need to levy the tax. That means you are registering and you are doing it. So it's important to understand, are you just going just to visit the trade show, do some networking and stuff, and then, or you are selling it. But a state like Texas, you even attend an event, then also you will trigger physical Nexus. One event in a calendar year, it can trigger Nexus for you.
So, Krishna, suppose I'm an edtech company and we sell modules to customers. Am I triggering a Nexus in any way?
So again, who is your recipient here? Understand the transaction. So usually people think like I'm selling it to a company. So let's say classic example, like ABC EdTech is selling it to a PQR entity. But the PQR entity is using this EdTech solution for their own for their own employees. Then we cannot see this as a B2B transaction. This is a B2C transaction because the consumer is a company here itself. And it's again, what is a mode of delivery? Is there any kind of an involvement of any physical material which is being shipped to them? Or how are these recorded classes or are these live classes which are happening? And if there is a live class happening, are they turning on a video? In a state like Wisconsin, you turn on a video, it becomes a taxable transaction. You turn off a video, it is a non-taxable transaction.
Okay.
Understand the modality there.
Yeah. Alicia, do you have a question? Alicia, do you have a question? All right. So last question, a couple of questions. So if we are a video gaming company popular in the US and we allow in-app purchases as well, because my entire business model is online, classify as a remote seller in that case, do I still need to be US sales and use tax compliant? We have to be, right?
You have to be, because you will be breaching. If you are an online gaming company, the chances are significantly high that you will breach the Nexus in no time. In no time. And there is also another aspect to this one as well. And when people try and do it through the marketplaces, like could be like an Apple Store or a Google Play Store and etc. So then they are marketplace facilitators. Then the taxation for that is taken care of the marketplace itself. So they are under a separate law called as marketplace facilitator law. So that needs to be observed.
Okay. So there's one question from Viral, if you want to address that. So I think the company has an existing account with Avalara and they want to request the account manager from India team itself. So you probably can reach out.
It is possible. It is possible, Mr. Virad. You can write down to me with your details, and probably we'll have someone who is assigned for that one for you. So we'll look into that one.
Viral, I hope that answers your question. And with this, we come to the end of the discussion. Thank you so much, Krishna. We're really grateful that you took time out and you shared the insights around the US sales and use tax. Thank you to the audience for your time, for coming on board for this conversation, and for the team for facilitating it. See you soon. Till then, goodbye and have a great day ahead. Thank you, everyone.
Thank you, Vaishnav. It was a great conversation. I really loved it. Thanks a lot for the audience and everybody. Have a great day.
Thank you, Krishna.